So let's start our introduction to taxes. So why do we pay taxes? We all know that we have to pay them all of the time, but we might not know what our taxes actually go to. So your 2018 tax dollar went to these things. So health, military, interest on federal debt, unemployment and labor, government, veteran benefits, food and agriculture, housing and community, education, energy and environment, international affairs, science, and transportation. And you can see how your dollar was broken down by the cents and see what your tax dollar is actually going to in the United States. So with that said, we see why we pay those taxes, and we're going to talk about some of the typical taxes we're going to encounter that we have to pay that have kind of a significant effect on our net worth, right? And just our daily budget expenses. So we pay taxes on sales, excise, income, payroll, property, capital gains, estate, and inheritance. So we're going to talk about each. So sales tax, we are very familiar with this. We generally pay a percentage of the price of the goods sold. So you could be paying 7% in certain states on the price of, say, napkins if you buy from the grocery store. It's levied at the point of sale. It's collected by the retailer, which is based on nexus. And nexus is whether a business owes sales tax to a particular government, depending on the way that the government defines nexus. So they could define it by having a physical presence, but this presence is not limited to having an office or a warehouse. Having an employee in a state could be considered nexus, as can having an affiliate, such as a partner website that directs traffic to your business page. So I like to think about nexus because New York passed an Amazon law, which requires internet retailers such as Amazon to pay sales tax despite their lack of physical presence in the state. And the only reason I did this whole entire tangent on this is because I love shopping on Amazon sometimes, because you don't necessarily have to pay certain sales tax because they might not have presence in a certain state, or there's all these different tax laws. So it's an interesting thing to just recognize and see, like, oh, do I have to pay something on Amazon? So sales tax is passed to the government from the retailer, and it's levied by states, counties, and municipalities. So next is the excise tax. So it's a tax on specific goods such as motor fuel, tobacco, alcohol, airline tickets, and health-related goods and services. So you get a tax at purchase, and businesses normally get excise tax and then pass on the tax to consumers in the form of higher prices. So, for example, when I look at airline tickets, they'll charge you, say, $500, even though it's only $400, because $100 might be that excise tax, and they do show you that. So it is cool to see that. But yes, they're passing those costs on to us. And then excise taxes are sometimes charged on retirement accounts. So a 6% excise tax is applied to excess individual retirement account contributions, IRA contributions, that are not corrected by the applicable deadline. A 10% excise tax penalty applies to distributions from certain IRAs, qualified plans, or 403(b) accounts when an investor makes withdrawals before age 59.5. Also, a 50% excise tax penalty is charged when investors do not take the mandatory required minimum distributions from certain retirement accounts. Required minimum distributions are mandatory after age 70.5 for traditional IRA accounts, 401ks, 457 plans, and several other tax-deferred retirement saving plans. So that's an interesting thing to just know, that when they kind of say that you're going to get a penalty with certain retirement accounts, it's taxed as an excise tax. So just good to know. Next is income tax, which we also are very familiar with. So taxpayers must file an income tax return annually to determine how much taxes they have to pay. So here in America, we have a progressive income tax system, which you can see in this chart to your right. So we can see the 2019 individual income tax rates ranging from 10% all the way to 37%. And so you can see, let's say, for example, you make 50 grand. So you would see if you're single, that would be in the 22% tax bracket, right? And so basically what would happen is your income from 0 to 9,700 would be taxed at 10%. The income from $9,701 to $39,475 would be taxed at 12%. And then your income from $39,476 to $50,000 would be taxed at 22%. And you can use that logic again with if you're married, filing jointly, or head of household. So the Internal Revenue Service, or the IRS, collects taxes and enforces tax law. They collect taxes on wages, salaries, commissions, investments, and business earnings. So your taxable income, if you want to get that definition, since we just talked about it, your taxable income is equal to your income minus your deductions. And then your tax obligations is equal to the tax owed minus your tax credits. That's just helpful to know. Both of these definitions are helpful to know when you're looking at your tax return and filing your tax return annually. So next is property tax. So local government levies property tax on real estate based on the percentage of the value of the property owned, that's including the land. So property tax rates and types of property tax vary by jurisdiction. So you need to check your jurisdiction to see the rates and also the types of properties they tax. So property taxes are equal to the property tax rate times the current market value of the property. So payment schedule of property taxes vary by locality, and almost all local property tax codes you can contest the tax rate. So that's a good tip to know, is that you can actually go and contest your tax rate. You just need to go to your jurisdiction. If property taxes are unpaid, you may get a lien against your property. And before you buy a property, you should always check for any liens, because you don't want to be in a situation where the owner before did not pay property taxes and now you're on the hook for that. So next is payroll tax. So that's a tax that an employer withholds from your salary and pays it to the government on your behalf. And so we often see this on our paychecks and we're like, wait, what? So this tax is based on your wage or your salary, and deducted payroll taxes are normally itemized on your pay stub. So if you see it on your pay stub and you're like, what is this? This is the explanation. So it's your income taxes, that's federal, state, or municipal, depending, right? So you're always going to get federal taxes, but state taxes might be zero, such as if you live in Texas, where I lived for 1 year, I had zero state taxes. It was amazing. In Washington or Tennessee. So you might have zero state taxes, and a lot of times people have zero municipal taxes as well. Also, this includes Social Security. So the Old Age and Survivors Insurance Trust Fund and Disability Insurance Trust Fund. And then Medicare is the Hospital Insurance Trust Fund and Supplementary Medical Insurance Trust Fund. So as of 2019, the Social Security tax owed by employees is 6.2% wages, up to $132,900. And the Medicare tax is 1.45% on all wages. So when individual wages exceed 200 grand or married couples filing jointly exceeds 250 grand, an additional 0.9% Medicare tax withholding applies to the employee only. So ultimately, you have to pay these taxes. It's just always taken out, right? Your employer just takes it out. And also, if you are self-employed, you have to actually pay these and then additional. So I think it's almost double. You have to basically pay what if you were just employed by a company, that company pays the government a percentage, and then you also pay. Whereas if you're self-employed, you have to pay that employer and employee percentage. So keep that in mind if you're self-employed. But you have to pay this. It's just the fact. It's just the fact of living in this country. So next is estate tax. So it's levied on estates that exceed the exclusion limit, where the amount that exceeds the minimum threshold is subject to tax. So it's calculated based on the estate's fair market value instead of how much the deceased paid for the assets. So levied by the state where the deceased person was living at the time of their death. And the estate tax does not apply to assets inherited by a surviving spouse, but when the surviving spouse dies, the beneficiaries may then owe estate taxes if the estate exceeds the exclusion limit, the unlimited marital deduction. So the federal exclusion limit is $11.4 million, which we talked about before. And there's varying state laws, so check your state laws. So to illustrate that exclusion concept, consider an estate that's worth $13 million. With the 2019 exclusion limit of $11.4 million, federal estate taxes would be owed on less than $2 million of the estate, or less than 1/4 of its total assets. So next is inheritance tax. So it's a tax levied by states on those who inherit assets from the estate of a deceased person. So 6 states have an inheritance tax. That should be Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. So there's no federal inheritance tax. And then the tax rate is based on the state of residence for state inheritance tax, the value of the inheritance, and the beneficiary relationship to the deceased. So if you're, if you're the child of the deceased, the tax rate would be lower. So it's applied only on the sum that exceeds the exception amount. And the lower valued assets and being closer relatives to the deceased persons are less likely to be taxed. Imposed on beneficiary as they receive the assets. So last is the capital gains tax. So the capital gains tax is levied on the difference between an asset's original purchase price and the sales price. So there's 2 types of capital gains tax. That is long-term and short-term. So short-term is for assets held for less than a year, and long-term are for assets held for more than a year. So the short-term capital gains tax is just taxed as ordinary income. So it's like being taxed like your wages and your salary. However, a long-term capital gains tax depends on your tax bracket. So let's look to the chart to our right of the tax rates for long-term capital gains. So say that you're a single filing status and you have capital gains of 100 grand. So you would fall into that 15% range. If you have capital gains of 10 grand, you would fall into that 0% range. And if you have capital gains of 500 grand, you would fall into that 20% rate. So the tax is only triggered when an asset is sold, and it only applies to capital assets, which are stocks, bonds, jewelry, coin collections, real estate property.